Thank you so much, Dave, and good afternoon, everybody. Already, I know you've gotten some great options education. I'm going to seek to keep it rolling as we've got also more great traders coming behind me, too. So basically, make sure that you're focused on the right thing when you're trading options, which is, for me, finding the right stocks to trade. And we're going to talk about the FANG stocks today, because they're frankly some of the best trading vehicles that are out there in the stock options market today. I'll walk you through that here. Just a reminder that everything I'm sharing with you today is for your information and education only. Nothing we talk about here should be considered a specific recommendation to buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. Big Trends and its staff are not responsible for any trade you choose to make. And not all Big Trends products and services are going to be appropriate for all traders and investors. As Dave said, every trade involves risk. You've got to trade with risk capital. Understand that you can lose what you put into a trade. We're going to talk about how we manage it for you with the FANG options trader today. At Big Trends, we don't provide any personalized financial, tax, or legal advice to any individual. We send out real-time email alerts and text alerts to our subscribers' smartphones when it's got a new entry or exit signal on this system I'm going to share with you. Do consult your tax advisor on anything that's going to impact your unique tax situation. So who am I? If you don't know about me, I've been trading for over 30 years now. I got started after graduating from Duke University and thought I knew it all and made those classic early mistakes, those early humbling lessons I consider to be kind of a gift of the markets teaching me on the front end. I don't want you to make those same mistakes if you're a new trader, but the reality is sometimes we have to learn the hard way, and that's how do you get experience? By making the mistakes, sadly, but truly in some cases. But I'm going to share with you what I've learned in 30 years plus of trading options on stocks. I'm a CFA chart holder and a CMT chart holder, so that covers the fundamental and the technical analysis sides respectively. Founded Big Trends back in '99. Blessed to be inducted in the Traders Hall of Fame in 2007. Our big thing is systems at Big Trends. We want to have data backing up every strategy that we do. There's nothing seat of the pants. It's got to be driven by enough of a trading edge that says it's worth putting risk capital into play. So today we're going to focus you on our FANG options trading system and how we do this, just keying on these big 5 FANG names. Particularly powerful is when we can use weekly options on these names. These are options that typically expire on every single Friday as a weekly options expiration. I don't want to trade them in a day or two before expiration. That's too risky. So I'm going to share with you how I like to trade these higher volatility stocks with these weekly options. I'm also going to give you my #1 indicator that helps you define a trending stock. On any time frame, you can use what I'm going to teach you today with this indicator. It's worked like a charm for us as active swing traders here. We're going to give you loads of case studies too, because it's all about modeling success. Now, unless you've been under a rock, you probably already know what the FANG stocks are. Facebook, Amazon, Netflix, and Google make up the FANG acronym, but we've said all along that Apple should be a part of that. These are obviously market leaders in a technology sense, but also when it comes to things like retail. You know, Amazon drives like a quarter of all e-commerce transactions. Facebook, of course, is dominating social media, you know, about Netflix and streaming content, Google and paid search, Apple, basically in the ecosystem of the mobile, basically a powerful computer in everybody's pocket thanks to smartphone technology. So it's really about, okay, saying these have become huge companies because of their innovations and their big time trading stocks and options on those stocks. I also like to get you involved and get a little feedback of what type of a trader you are. Just type in the chat box a number 1 through 5. If you're a day or quick trader, 1 to 2 days, type the number 1. Swing trader, 3 to 5 trading days, type the number 2. Or position trader, 1 to 4 weeks, type the number 3. Is your predominant trading style when you think about what kind of trader you are? I always love to know what kind of crowd we have. Or if you just buy and hold, it'd be number 5 for passive investor. I don't think anybody here is going to be passive. You're smart to be educating yourself on different strategies. So we got some position traders coming in. More than not, number 3 is probably the most popular of the crowd here. And for what I'm going to show you on this indicator, I would say focus on the daily chart. Okay, so look at the daily chart interval when you're more position trading over 1 to 4 weeks. For swing traders, I'd say up to about a week. Look at the hourly chart. I'm going to be looking. I'm about a 1.5 here on what I'm sharing with you today. Kind of a quick trader, but we're going to look at a 30-minute chart. Okay, so every 30 minutes I get a new candle, and the 30-minute intervals really give me a way to focus on this. If I was day trading, I might even look shorter than that. But the bottom line is that these are about 2 to 3 day trades on a 30-minute chart. Now, why should you care? Obviously, past performance never guarantees future results. We can't guarantee performance. I like to think we can get better as we grow, but the bottom line is that every trade involves risk. There's drawdowns in every strategy. You got to realize that. But over the course of when we launched this FANG options trader out to our big trends community back in August of 2016 to current, as of yesterday's close officially, that basically we've generated $10,306 in profits, assuming that we just made one contract that we bought per trade. These days, we don't put more than $1,000 into any option trade. So you can do this with a relatively small account. One of the big things you're going to learn here is that we use 100% profit targets with some dynamic trailing exits. If we're starting to give back too much of our profit, we'll cut and run even before the indicator I'm going to share with you would roll over. So if you were trading, say, a $5,000 account, again, past performance doesn't guarantee the future results. Could be better or worse going forward than it has been. But the bottom line is that, it'd be a 206% gain since August 2016. That averages out to about 43%, which is well past the S&P. And part of the reason it's better than the S&P is that, we had the pandemic plunge last February and March where the S&P lost 30% in 5 weeks. And that's why I tell people, I don't think you can just buy and hold the market anymore and feel good about it overnight on a daily, weekly, monthly, and yearly basis without worrying that we might have another very sharp haircut because the market's very pricey. But we can trade just one contract a trade, be in and out in a matter of a couple of days and not be committed, make up to a double, and then get that money back in our subscribers' accounts and back into cash and say, let's figure out how to roll it over. And you can do this in retirement accounts at certain brokers that'll let you buy these options, because these are just option purchases. These are not spreads, nothing complex here, no covered calls, nothing selling options. It's just buying a call or buying a put. When it's time to get out, you exit that same option. So really, really simple. Now, how about more recently? What have you done for me lately over the last 3 quarters? This portfolio up over $2,300 using that $5,000 model portfolio number. You can see that's pushing towards about a 46% return gross. These examples are before commissions. One of the great things that's happened in my 30 years of trading is the broker price wars that have taken stock and option commissions down to next to nothing, if not nothing. So basically you keep almost all of what you earn these days. And if you're paying too much for options commissions, you need a new broker. So the reality is, make sure you do that. Let's talk indicators. And you don't need a lot of indicators with what I'm going to teach you. In fact, the one I really want you to focus on is this green line on the bottom panel. You may have a clue of what this is. Starts with an A. Second initial is D. You probably know the last one if you traded for a little bit. X. ADX. What is ADX? It's the average directional movement. It's developed by Wells Water. We'll get into that on the chart as I explain the indicator here in a couple slides. But what are we looking at here? When ADX is going up, it's a sign of a trending market. Now, the wrap on ADX, the knock on ADX has been that it didn't tell you what direction the trend was happening. But actually what we do is we overlay what Water called the DMI lines, the positive line in blue, the negative line in red. What does that mean? What's a DMI? Well, it's just, think of it this way. Are we making higher highs? You can see on this chart, yeah, we sure are. Are we making any new lows? No, we're not. The red new lows line essentially is going down, meaning you're making less new lows. Isn't that the definition of an uptrend? No new lows and a lot of new highs. That's going to lead to a pretty attractive looking chart to the upside. ADX can trend up when the market's downtrending. We've got some bear examples for you too. But the idea here is that, where do we get into this trade? We get in when ADX starts to cross up off a relatively low level and turns up above this declining directional movement line, in this case, the negative directional movement. So saying we're getting less negative directional movement, and by definition, ADX is rising because you're getting more positive directional movement. Think of it also as like, what's the spread between these two positive and negative lines? You can see the spread's pretty narrow, and then it's starting to expand, right? We're starting to get some range expansion and some basic trend action where we're getting higher highs, higher lows. That's bullish. That's an uptrend developing. ADX picks that up and starts trending. Notice that a lot of people would say, okay, well, wait until ADX gets up to, say, 40 or even 30. At 40 ADX, you've missed more than half of this move here. So to me, I say it's got to start trending up from a relatively low level and then cross that directional movement line that's coming down there. At that point, we're saying at that close, this is, remember, a 30-minute chart. These are TradeStation charts. We're not platform dependent. You can do this strategy on a lot of platforms. ADX is a pretty common indicator, but it tests well when you find this pattern. And we call it out for our subscribers as real-time email alerts and text alerts to their smartphones when it's time to get in. Now, when we can double the trade, this is a Facebook. We're going to talk about options right here in a sec now. When we can double this, which happened the next trading morning, so we made our double in less than 24 hours, but it was in 2 different trading days. So we are not trying to day trade here. We're looking out preferably 2 or 3 sessions. So we don't have to worry, even for smaller accounts, about doing a bunch of day trades. That's not our game. Our game is a quick swing trade, 2 or 3 sessions typically. But we can be in and out the same day if we get our target or hit our stop. More on that and 2. But bottom line is that what are we buying for an option here? We're buying a weekly option, usually with about a week to 10 days before it expires. And we're buying, in this case, 252.5 strike call when Facebook's trading where? About 257.5. So about 5 points in the money is what that means from an options terminology. We're paying $910 to control 100 shares of stock. They're quoted at 9.10, but you got to multiply times 100 because each option contract controls 100 shares. So if you're putting in $1,000 to trade at maximum here, in just about every case, you're going to get 1 contract. Not 2, because we tend to like these more what we call stock substitute plays, where you can get a good amount of intrinsic value on a Facebook, on an Apple, sometimes even on Netflix. Now you can't do it so much on Google and Amazon because they've just moved up too dramatically. Amazon just recently surged again in the 3,000s, and you're saying, okay, hey, we're going to have to buy out of the money in those cases, but we're going to be really keeping a close watch on those. And when it's time to go, or when our trailing stops get hit, we'll say get rid of it. So let's keep it moving here. I got a lot to show you in this kind of short time frame I've got to share this with you. So Apple, notice there's a black line on this chart. MA, you probably know what that means from a technical indicator standpoint. What does that stand for? Moving average. Okay, so the idea here is that, and William says, why not buy out of the money options? We do with Amazon and Google, William, but we don't with these names like Apple and Facebook, because we're trying to minimize the time risk. We can still get dramatic leverage in a 2 to 3 day window and not have to worry so much about time decay. Time erosion is your enemy when you're an options buyer. So you try to minimize that wherever you can. Amazon and Google, you gotta say that we follow the option that's the right option under $1,000 a contract. So we buy in this case right as it crossed that moving average, which is a filter. If it was below that, and you see I changed my color here to yellow on that second 30-minute bar in, that you say, okay, just crossed above there, so we're getting into that 123 strike call. When Apple, you can see, is trading in this neighborhood here of about just over 131. So it's just over $8 of intrinsic value. We're paying $9.18, $918 to control 100 shares of stock that if you bought 100 shares of Apple there, it would cost you over 13 grand. So you can start doing the math on your leverage ratios, and you can get some pretty dramatic leverage. Notice ADX is the big thing about ADX. It's now the yellow line in this chart, but the principle is the same, which is that look at how steady that ADX is all the way up until it rolls over right here. Once it rolls over, we're going to want to be gone. So at that point, you can say we're getting out of that trade right there, up 60%. Turns out that one, actually, our profit protection kicked in to say, okay, it's giving back a little bit more of our profit than we would like, so let's take the 60% and run. We could have made a double the next day. Once in a while that happens where we get faked out. I'll still much more gladly take these steady gains and not let a big gain turn into a loss. That's one of our big objectives, is to make sure we can create a more consistent experience in terms of results for our subscribers. So it doesn't matter about platforms. I love TradeStation, Thinkorswim, Metastock, and more. You can use it on any platform as long as you've got an email address and or a text alert capability on your smartphone. You'll be getting a real-time alerts from us when you become a subscriber. We keep it real simple. The DMI lines are our guide. The moving averages are just a filter. So that's just kind of a screen to make sure that we're not like buying a short-term up move that has a longer-term down move. That would be a problem. We want to line up. It's like 2 rivers flowing into one. It'll be more powerful when you get them both flowing in the same direction, short-term and longer-term. ADX is our #1 tool here that we're using. So that's what we're keying on. I'll talk about ATR here in a few slides as well. But the goal of all this is to say, I don't want to trade every bar, every little candle, every little possible pattern. I want to create a funnel that tells me, you know what, if you get the best of the best funneling action here, that'll give you the highest quality trades. I would much rather trade less often with greater quality and greater confidence than to trade all the time and get my confidence and my capital chopped up. One of the things I love about ADX too, folks, is that you see it's just turning up on Apple in this example here before this price breakout. So we get our signal at the close of this green candle here about 1 o'clock on that trading day. That was October 9th. Now notice, you look back here and you say, hey, it's not even broken out yet. If you wait for the breakout and you wait for here, when it breaks out on the next day's gap up, look at how much money you leave on the table. Our entry is about 116.5. We're buying an October 107 call for, it's worth 9.5 intrinsically. We're paying 972 bucks. So 972, we're only paying less than a quarter of a point out of an almost $10 option as time value. That means that 95+ % of this option is intrinsic value. This is a true stock substitute. You're going to be moving practically point for point. So if you know options Greeks like delta, you're going to have a very high delta, over 95% on that option. And you see, we're already in before the gap at 116.5. If you bought after the gap, you're in at 120.5, 4 points later, and our exit's coming about 124.5, and you've left half the move on the table if you wait for the, quote, price action breakout. So I know some traders who tell me, oh, I only trade price action, indicators have lag. And I'm saying, well, you're going to miss some great patterns that are actually giving you an early indication that this thing's about to break out to the upside. It's in progress. The structure of this obviously is already starting to power ahead here as we head into that close from that 1 o'clock entry. So we can get the signals right off of the open at 10 a.m. Wall Street time. We can get them right before the close. Every half hour that we get a new candle, and we thus get new data that we share with subscribers when we get a new signal. So we want to make sure you take advantage of it when you become a subscriber. We're going to generate about 6 to 8 trades a month. So we're not going to do too many. A couple trades a week is our typical average. Here's Netflix soon after the open. This is a more of a classic price breakout, but it's confirmed by that ADX upturn. So a lot of times they do come fairly soon after the open in the first 30 minutes. We won't ever be buying at 9:30 right on the open. We got to see that first candle, and you can see this one. A lot of people will miss this trade because they go, hey, it was just trading here the prior afternoon down at about 365, and now you're telling me to buy it at 380? And in this case, we're buying the at the money call on Netflix with about a week and a half to go before expiration. And we're saying, yes, that's what you want to do, is buy that 380 call for 950 bucks. Again, if you bought 100 shares of Netflix stock at 380, that's going to cost you 38 grand. So for less than $1,000, you're controlling $38,000 of stock. Obviously, the leverage there is tremendous. And in 2 hours, the stock moves from 380 up to about 395. In percentage terms, what's a 15-point move on 380? You're talking about essentially like a 4-point move, a 4 percentage point move. 4 percentage point move is a double in this option in 2 hours, so about 25-to-1 leverage for just a couple hours work. It's important, though, that you're around for that. I will get subscribers who will say, oh, I could have made much more by just continuing to ride it. And every once in a while that's true, but there's a lot of other times where you could have let a winner turn into a loser if you're too passive or too greedy. So don't be greedy. Greed is not good and it can say, the old Wall Street Gordon Gekko quote. It said, greed is good, greed is not good. Don't be greedy. Take that double when you get it and move on to the next opportunity. So as I mentioned, Wells Wilder, same guy who developed the RSI, Relative Strength Index, very popular oscillator. His big contribution in this particular indicator, he made many great innovations in his trading career, but the idea is that he said the true range, if you look at your classic like open, high, low, close, open on the left, close on the right, high and low, you can tell what's happening here. You say, okay, look, we've got another second day in here. And you say, okay, most people would say, well, the second day's range is the high to low range. We'll call it R here, okay? Well, Wilder's saying, hold on, guys, you're missing something here. He's saying there was a gap. It gapped up. Take the high down to the prior day's close, and he says your true range should encompass the gap, if any, So true range can only be equal to or greater than. If there's no gap, it's equal to the day's range. If there's a gap, you factor in the gap as well, and it will be more than that day's range. So essentially, true range will encompass more total movement, and thus you will see how much true trend you're getting, not just the day-to-day ranges. So we care about, even though it sounds like thus we would care about ranges, we don't. We don't want to trade ranges, which are the chop back and forth. We want to trade those higher highs, higher lows situations, or vice versa on the downside, where it's making new lows and breaking down. DMI lines will help you to see those trends against the ADX. Here's a bear example. We flipped the script now. So we still have the same ADX cross off a low level starting to turn up here, but now it's happening on the downside. So we've got a bearish signal at the close of that first gap down bar on Amazon. And again, Amazon was trading here about 1780. And you can see that that first day, not a lot's happening. That's a Friday. I remember it well because it's a Friday. We're slightly to the good on Amazon stock, but we're not making that much money yet. And this is actually when we used to buy options even over $10 a contract or over $1,000 now. We actually have tested and said it's actually better to trim it back down to at least a maximum of $1,000 a contract. We paid $14.17 on this one and still went to 50. And that thing, because that next Monday it was gapping down, and as we got our orders out, by the time they got filled and the speed of movement drop right here, this first massive red candle down, by 10 o'clock, you can see that this thing's gone from 1780. Now here we are, interbar touching down near 1700. So that 1745 put intrinsically has to be worth at least 45. It's trading at about 50. There was a little time in it still, and that was a 243% gain. Don't expect that, but occasionally you get windfalls like that. And again, you say, well, if you wait for ADX to roll over, maybe you could make even a touch more. But to us, it's not worth the risk of leaving that money on the table and watching it gap the other direction the next trading day. So when you think about ADX, the whole principle here is that we're looking at these DMI plus and minus configurations. Like I said before, if DMI plus is going up, that's an uptrending set of new highs. DMI minus is coming down. That means you're making higher lows as well. Of course, you know that's the definition of an uptrend, and vice versa on a downtrend pattern. More negative direction movement, less positive. Both of those create a higher ADX. So the goal here is to basically start comparing how stocks are moving relative to their true ranges to see where the trends are starting to kick in. This was a dramatic move in Netflix right off of a start of February move here. And it was Deadsville before that. You know, I never would trade this chop here. Never try to buy those lows, sell those highs. Because as soon as you get a big blast to the upside here, you're going to get just creamed by even trying to fade that strength and then watching it shoot on through that resistance and push past. You can see it pushes from 345 to 355 in 30 minutes. That's a big move. And you see, of course, if you're on the wrong side of that from an options perspective, you've got big problems. If you're buying puts at the top of the resistance, then you're trying to cover those as it blows through there. You know, you could really get your head handed to you very quickly. We don't recommend that. We'd rather say just wait for the big trend to tell us that it's setting up. We waited until the very end of that bar. You say, well, haven't you missed it? If you're buying right there, it's already up to 355. And you can see first day it kind of chops around. But then the second day, it steadily moves on up. We end up taking 85%. As you can see, the ADX just slightly rolls over there and says it's time to go, move on. Still a nice trade for a couple days work. So the beauty of this is that you don't have to be a hero. You don't have to, try to get in before the breakout. You actually want to see that confirmation, that follow through, and that tells us that indeed we've got a great opportunity for a lot more institutional interest. Let's face it, the institutions are the ones driving these stocks and markets, not you and I as individuals. So you're really saying, look, they want more of a good thing just like you and I do, and so they're going to keep piling in when the patterns are right. Where we can, we want to use in the money options. I'm like, why would I buy this house when it's a lot cheaper and more cost effective to rent it? You know, why tie up your capital in that house? If you buy that house, I'm in Kentucky. In February, it's cold here. We want to go to Florida in February. Well, we're going to pay a premium because a lot of other snowbirds want to do that too, right? You're going to pay a little more than the monthly rental cost to go at a prime time. But to me, that's still worth it because I don't want to be there. I don't want to have those carrying costs the other 11 months of the year. It's the same thing for these stocks. Google shares, as you know, are way past this price level now. Same with Amazon. 100 shares can cost you several $100,000 on Amazon. and we're not going to pay now more than $1,000. Our leverage potential is getting up into the hundreds of times now when we talk about Google and Amazon. So we see Google just starting to break out here. It was about 2 o'clock on the trading day there, saying, okay, now we've got a signal just over 1245 in the stock. We're buying the 1245 calls. You can see it doubled the next day. Interesting, on a lot of these, you'll see that at the point we take the double, it can either stall or it can even reverse. So, we were not going to wait for this possible next day to shoot against us and leave money on the table. In another Google example here, you can see this is fresh off of a big breakout. Notice, by the way, look at the moving average here. It was kind of hovering around the moving average the day before, but it was starting to hold that. By the way, we give all these settings to subscribers when you become a subscriber at whatever subscription term we have on special, which we'll talk about that too before we're done. But the bottom line here is that, you know what, we don't mess with that trade until that ADX turns up on the gap up and the follow through the next morning. So this is right at that 10 a.m. Wall Street time point. And you'll see on a lot of these that after we get that signal, look, it's pretty much stuck for most of that day. And so if you buy into that and you go, okay, we were buying the 1510 calls and the stock is trading around 1490-ish, and you say, well, gee, you're not making any money that first day. Don't panic. Don't be reactive to the fact that it's flagging a little bit. That's a classic flag pattern, right? Runs up the flagpole, then the flag is waving there, and you say, okay, it's consolidating, it's catching its breath. But the key is, look at ADX. It's definitely not going up as fast as it was there, but it's not rolling over yet either. If it was, we'd be getting out. So ADX gives me a stabilizer when I look at the 30-minute candle by candle price action and not get too overreactive. You see this couple of little red candles here? A lot of people will go, oh no, it's rolling over, it's breaking down. And I say, not so fast. ADX is still hanging in there. It has not rolled over yet. So hang in there. And so this is a real guide for me that says, okay, you know what? I know people that tell me they just want to trade price action. They don't want the lag of indicators. And I say, let me give you this neck brace here. You're going to need it for the whiplash and the fake outs that you endure amid trying to find the true breakouts. ADX is a much better guide for me. And you can see we end up getting on that third morning gap up. We get that 156% gain. For a couple days, and we're getting a nice little gradual uptrend with that third day gap up. And you say, oh, well, man, you left some more money on the table. Again, happy to do it if I can make 156% in just over 48 hours. So the idea here is that, you really want to focus yourself on the true trend. And I think that's what ADX shows. And that's what I love about Wilder's research is it shows us that true range and that extra gap element that wasn't in a lot of the other range tracking indicators before Wilder's time. So now this is an evolution in my trading as well. When I launched Big Trends in 99, I did it trading a lot of these Humana type of setups where I was buying about an 80% delta, pretty high delta for an option. And if you're new to delta, what that means is that when the stock moves up a point, your option should go up about 80% of that. So 8/10 there. So if Humana goes from 300 to 301, this $9.40 option should go up to what? Should go up 80 cents to 10.20. You say, well, that sounds pretty good. I'm getting some nice immediate bang for my buck on a third of a percent move. In Humana, I'm up almost 9% on the option. So that sounds good, right? And this has an ATR that's about 2.25%. And you can see that in comparison, if I look at Netflix, let's say about a similar priced option, a $9.50 option, similar time to expiration, we can only go about 5 points in the money. And you see that means that we're paying a bit of higher time premium. That means our delta is actually about 60% rather than 80. In the old days, I would have said, no way, no thank you. But notice, here's what you're paying for. The daily ATR, the daily average true range on Netflix is almost double Humana. It's 4.25%. Humana, you see, is 2.25%. So that means if you do get your one ATR move in both cases, so Netflix goes up 4.25% or Humana goes up 2.25%, that Netflix option goes up 89 2/3%. Humana goes up 57.87%. So you actually get 55% more profit on an ATR move in your favor on Netflix than you do in Humana. The one caveat of this is if you don't have a directional advantage, if it goes the other way and you get a daily ATR move against you, you can get 1.5 times the move against you as well, right? So this is why having a directional advantage is so important to me. This is not a non-directional strategy. This is definitely about getting direction right. Here's another bear example. Netflix breaking down. You can see here the second bar down there, we're getting the signal right when the stock's about 275. We bought the 267.5 weekly put options for the following Friday. We paid $869 to control 100 shares on the downside. So I would never short sell a stock when I can buy put options. For me, it's like all this stuff that happened with GameStop and everything. It was like, why would these people be that short when you can just buy puts? Obviously, at the size they were trading, it's a whole different game for those big institutions, right? But I'm like, for you and me as individuals, I think the puts are a much better way to play than short selling a stock. So we bought the puts when the stock's at 275. We're buying out of the money puts. We're buying a 267.5 put. That first day on the 19th, it drifts down to about 270. We're making a little bit, but not a lot. But then look at the gap down the next morning. It goes from 270 to 255. This is where we get those windfalls sometimes. This isn't a big windfall over 100%, but 109% and change the next morning. Now, the key I want to show you here, though, is that you say, look at how many times you left money on the table. Well, look, if you wait for ADX to roll over on this one, by the end of this bar, it's right back up to where you got in at 275, and you've lost a day and a half, trading day and a half's worth of time. So you're going to be in a losing position at that point when you see that flip back up and the time decay is hit. So don't let a big winner turn into a loser waiting for that to hang around. We take the double or double plus when we get it. If you're new to the concept of weekly options, real quick, the idea is, like back in April, we had 5 Fridays. That was 5 weekly expirations where you could have opportunities to do the strategy again and again and again. In the old days, I would just do it in the old monthly expiration, which was the 3rd Friday of the month. Just do that last week before expiration 1 time a month. Now I can do it 4 or 5 times a month. So we can do this ahead of key events. But most of what we like to do is we don't like to do this right in front of earnings. We'd rather say let's trend trade well ahead of earnings or once the earnings are passed. We've just gotten all these FANG earnings behind us. So when you see a launch like Netflix, I don't know about you, but I talk to a lot of big trends traders coming in who say they miss a lot of these moves when they're first coming to us, saying that they wish they were taking advantage of this. Netflix the day before was at 490. We get our signal at 510 in the first 30-minute bar. You go, you're buying after a 20-point move up? And I say, absolutely yes. Right there is our entry, okay? Arrow on that, okay? I'm not buying at the beginning of that bar. I'm buying at the end of it, waiting for the confirmation at the 10 o'clock Wall Street close in the morning. And you say, okay, the close of that 30-minute bar. And you see, that's a powerful sign that there's a lot of buying interest. And so we're getting in there on the 525 calls when the stock's about 510, paying $846 on average. And you can see we got a double the same day. It's a few hours later. So the beauty of this is that you don't get stuck waiting. You don't get stuck holding the bag when it gaps down on you later. You're taking the double when you can and moving on to the next opportunity. A couple more quick examples, but it's all about controlling risk. So we'll tell you not just when to get in on and out of a good trade, but also if it's not working, we'll tell you how to put your initial trailing stop in and then how to gradually trail your stops. One of the great things about these signals is that when we get one of these, like this Google breakout here, you see this next couple hours, it was a little bit against us. But look at what ADX is doing. It's still going up through that little price consolidation. And so you can see that by the next morning, then we're getting the surge up, we're getting the double, taking the money. Again, it paid to not wait for this ADX rollover, which would have happened much lower below 1150, and we're cashing out up here above 1160. That's a big difference, both in time loss and in price action loss, if you're waiting for that rollover when you could have taken your double and run. So some of the key elements of successful FANG options trading is the catalyst has to be there. We don't trade until we get that right ADX pattern. In the money where we can, but sometimes we have to go with Amazon and Google, and now these days even a little bit with Netflix, to at the money or out of the money. These ADX turns will dictate an exit, or if we get our trailing stop hit Once we get a gain of at least 30%, we'll start sending out alerts that say, hey, raise your stop to this, break even, raise it up to a profit, raise it up to a higher profit. So it's a very gradual but steady process. Or if the 8X rolls over, say it's time to go, get out, move on. So we give you real-time trade alerts on how to do that. The upside potential at a double, when it hits a double, we don't ask questions. We exit first, ask questions later. It's proved to be a very effective way to grow the portfolio for subscribers and to give a more consistent experience. If one of those doubles turns into a triple, is at plus 200%, and one of them goes from plus 100 back to zero, which would you rather have, 2 plus 100s or a plus 200 and a zero? Technically, they're the same, but I'll assure you that our subscribers will be a lot more stable and happy with a couple of doubles and the consistent experience rather than the volatile experience. We basically harness that volatility and help you manage it. It's not a black box system. I give weekly video trading updates so you learn while you earn. I constantly update all open positions, teach you with the settings how to take advantage of this. If you came in late on my presentation, over the last 3 quarters, with one contract to trade using a model $5,000 portfolio, we'd be up over $2,300 before commissions, and commissions are down to next to nothing. So you can see it's worked out really, really well using this approach. That includes winners and losers. Since inception, over 10 grand of that same one contract to trade, again, before commissions. So the beauty of this is that you get a ton of value with big trends. And so what we want to offer you here today, I've only got a few minutes left, so I'm going to just quickly go over this, and you'll have to make a note of it. So if I know Dave and his team are going to post it, but it's members.bigtrends.com/FOT12. FOT like FANG options trader. So that O is a letter O, and then 1-2 for 12 months. So members.bigtrends.com/FOT12. What do you get? You're not just getting the core 12 months access to the trades, which will give you about 100 trades over the course of the next year's access. I'm also going to give you access to 52 weekly video updates. Every week I do this extensive update on all the FANG names and what I'm seeing and what's next based on the indicators. I'm not just going to give you just an entry-level training here. I'm going to give you extensive weekly options boot camp training. That's another several $100 value. And I'm going to give you the settings and rule sheet, which is another couple $100 value, so that you basically can follow along at home wherever you're tracking on your computer or your phone how these trades work. You don't have to have any certain platform. We'll call it the trades. And I want to show you quickly also about, that you can also get this via text alert, not just via email. You can also, by the way, call our 800 Big Trends line if you have any questions. We've spelled out what that is, but just remember 800 Big Trends if you have any questions. So it's members.bigtrends.com/FOT12. It gets you to this page right here. And we are really about keeping it simple on these pages to allow you to quickly get signed up. We do encourage you to review all the terms and conditions. If you're not familiar with BigTrends.com, I launched the company in 1999, so we're on our 22nd year in business here. So we've served a lot of thousands of people for more than a couple of decades and counting. And so you can see that what you're getting here is all that value that I just shared with you is more than $2,300, almost $2,400 of value, all in for a one-time investment of just $497. So for $497, I'm going to call it the next year's worth of trades. That's at least 100 trades. That's less than $5 a trade, essentially, you're paying when I just showed you how one of those trades can take a potential $1,000 investment and turn it into $2,000, turn it into $1,000 of profit. So one trade could actually make you double your one-time investment here on just 100% winner that we call out. So it's really a powerful value, and it's a powerful way for you to keep learning and keep watching how I teach you about this over the course of the next year with this special offer. I'm out of time, but make sure you go. The easy way to do it is click the terms and conditions, go click on the PayPal link, or you can pay with a credit card, but do take advantage of it. It's really a powerful strategy here, and one that I think you'll love the consistency of. Members.bigtrends.com/FOT12.